Most IR teams of listed companies typically wait for investors to come to them. They respond to inbound requests, they go to the same conferences each year, and very broadly speaking, they meet the same groups of funds year after year. It is the reactive and maybe the default mode, which is generally accepted way of doing things around the world in our industry. If an investor wants to talk to us, he or she will call us, right? In this short video, I wanted to share a new idea. And that is to introduce the proactive approach, where we can see the full picture of the investor universe and where you are in control, who you reach out to, when, and for what. So whether it's a roadshow, a capital market day, an earnings call, or a one-to-one meeting, you decide who gets invited, and you build that outreach around the curriculum that you can design. Let me share with you a few ideas of how this can be done. But before we talk about targeting investors, let's talk about the investor landscape. And when we use the word investor, we probably need to be just a little bit more specific. For example, there's a big difference between BlackRock, the group, BlackRock Asset Management, the investment manager, BlackRock Emerging Market Fund, the fund, which is often its own legal entity with its own assets, its own rules, and its own restrictions. In investigation context, the fund is what we actually care about the most. And that is because the fund is actually what buys our stock. And the funds come in different types. Knowing which fund we're engaging with potentially changes the nature of that engagement. To start off with, there are two main categories. The passive funds, those can be exchange-traded funds or ETFs or index trackers. They own you because your stock is part of the index. And what we do from an IR perspective doesn't necessarily change their allocation, but governance or ESG engagement still often matters to them. Then we have active funds, teams that make deliberate choices, picking stocks and trying to beat a benchmark. They'll read the presentation, attend the roadshow, ask often hard questions, and build a meaningful position in the company if they believe the story and the valuation is right at the time. And then within the active funds, you have many, many different types. And there are many, and we can talk about a few of them here. Firstly, we have mutual funds who raise capital from many clients, invest accordingly to a defined mandate or investment strategy. We have fundamental-driven investors who make decisions based on stock characteristics, such as dividend yield, EPS growth, or valuation metrics, such as the PE ratio. We have thematic funds who are investors that back a specific idea or a theme that they build their portfolio around. For example, energy transition, digital infrastructure, or aging population could be such themes. We have hedge funds, which can be long or short, which means they can either own your stock or bet against it. And the ones that go long can be very high conviction holders, but they also tend to have shorter holding horizons, and often they will ask some of the sharpest questions of anyone you'll meet. Then sovereign wealth funds, pension funds, endowments, patient long-term capital, and then finally retail investors who are individuals like you and I who have access to a broker account and who can buy shares. And oftentimes, they will be also your customers. And there's more, and often subgroup of the ones I've touched on just now. Each fund type has different expectations, different investment horizon, and ideally speaking, we would want to have a different conversation with you. The important thing to note is that every fund, every single one of them, has an investment mandate. And we can think of the mandate as the fund's unique rulebook. It is an agreement that defines where the fund is allowed to invest and where it is not allowed to invest. A formal mandate can cover many areas. For example, it can dictate geography, where the fund can physically invest, whether it's emerging markets, developed markets, Europe, Middle East, or one specific country. It can define the asset class, for example, whether the fund is focusing on equities, debt, commodities, real estate, or whether it's investing in public or private markets. It can define the sector, for example, whether the fund focuses on energy, technology, banks, or consumer companies. It can also define the size. Some funds are only allowed to invest in large companies, while others specifically are mandated to invest in small and mid caps. It also defines liquidity, meaning the fund can only invest in companies where there's enough daily trading volume to enter and exit the position. And it can also have exclusions. A fund may not be allowed to invest in tobacco, weapons company, fossil fuels, or any other sector that does not fit its framework. And the interesting thing for us to think about is that our investment case, no matter how attractive it is, cannot override the mandate. We can have the most exciting investment story in the world. However, if our company does not fit into the mandate of those investors, we cannot attract that capital. And generalizing very broadly, small funds have the ability to look at smaller companies with lower liquidity. Larger funds often need bigger positions, which means they need deeper liquidity and larger market caps. The very largest funds around the world can only invest in the biggest and most liquid names in the world. So before we talk about our investment case, it is worthwhile to understand who can actually invest in our company. And this brings us to what we call the addressable investor universe. Out of the tens and thousands of institutional investors in the world, how many of them can actually invest in the stock right now, given the liquidity, market cap, and geography and the sector of our company? And this is our targeting project. So how do we go around doing this? Here's one framework. All you need is an access to a good investor database and your own CRM or meeting records. Step one is about defining the targeting universe. As we discussed, using your liquidity, market cap, sector, geography to come up with a long addressable universe that matches those of the investor's mandate. That list can be divided into 3 buckets. First, existing shareholders you know well and engage with regularly. Second, shareholders already on your register but you haven't spoken in a while, perhaps who could be interested in a refresher meeting. And third, new prospective investors who don't own you. And one good starting point here would be to look at who holds your closest peers but doesn't own you, and who you have not met recently. Those are the funds that typically understand your region, sector, and already have the mandate that fits your profile. Once we have the fund universe defined, it's worthwhile to consider who are primary contacts or people within the institutions. And broadly speaking, every fund has 2 contacts that are most relevant for IR. The portfolio manager, who makes the investment decision and controls the capital, and the analyst, who does the research, builds the model, and actually is typically the first point of entry into institutional investor. They have different expectations from a meeting within IR. The analyst typically wants data, depth, access to management. They're building the case. The portfolio manager, on the other hand, wants a high-level headline story and conviction. They're often deciding whether the stock of the company fits their portfolio. Second step, define your curriculum. And this maybe requires a little bit of a mindset shift. In IR, we're not in the business of selling our company to investors. We're actually in the business of educating them. Maybe this is a bit funny, but we think of them as long-term investors of the companies and industries they invest in. And you are the professor. Your job is to give them knowledge, the data, access they need to form their own conviction about your company. You don't convince investors to buy your stock. You give them everything they need to convince themselves. And like any good teacher, you have a curriculum, your earnings call, your investor deck, a capital markets day, site visit, a one-to-one meeting with the CEO, a factory tour. These are your teaching formats. The question then becomes which content is right for which investor and at which stage of the relationship. And that takes us to the next step. Step 3, build an engagement calendar around your targeting list. Once we have the addressable universe prioritized together with the curriculum, we can start matching activity invitations to the target list. A first-time meeting with an investor might just be a clear introductory meeting, the headline story, the basics. An investor who has already engaged may need a deeper access, a site visit, a time with a CFO, or a session with a business unit. And your largest and most committed investors may even ask for direct time with the CEO. Many companies around the world publish a complete IR calendar and allow investors to pick what they find most valuable. But this is not only about access, it is also about content. In the best case scenario, we should be able to some extent tailor the presentation to the specific requirements of the investor, taking into account the type of fund they manage and the questions they have asked before. For example, a fund manager who often asks about ESG may also value a conversation with the sustainability team. A long-term growth fund may be most interested in the 10-year expansion plans. A debt fund may care more about the resilience of the balance sheet. The point is that the material we present should not be static. It should reflect who's in the room, what they care about the most, and where they are in their investment decision-making process. And this is quite often where good CRM records become very, very powerful. Because over time, you start seeing patterns. Who keeps asking about margins? Who always comes back to governance? Who wants more operational detail? That intelligence helps you tailor not just who to invite for which activity, but what you actually say in the room. So the point, quite simple, is in theory, do not give everyone the same investor experience. Segment by investor relationship stage, by investor type, and what we know about them. And finally, step 4, get feedback and refine. Many strong IR teams use the discussions with investors as a source of feedback. What are the frequently asked questions or the FAQs? Which parts of the investment case were clear, and which part did investors keep challenging or asking you to explain again? As many strong CEOs recognize, good investor questions are often the same questions the management team should be asking themselves. They help reveal risks, test assumptions, and sharpen the company's internal thinking. The questions also show what investors are actually hearing in an investment case and what is missing. Many strong management teams include investor feedback in their board discussions, and it's often a base to refine their overall communication strategy. Proactive IR doesn't plan to replace reactive investor relations, but proactive investor relations sort of completes the picture. It's how you reach the parts of your addressable universe that would never have found its way on their own. And over time, it gives you something even more valuable, and that is control. Control over who your audience is, control over what your story they hear, and in what format, and in what moment in time. And of course, over the long term, eventually, the control over the quality of your shareholder register.